Hello everybody, welcome to the NFO review series. I'm Rin Agarwal. In this video, I'm going to be reviewing the IDFC Gilt 2027 Index and the IDFC Gilt 2028 Index Fund. First off, what is this fund all about? Well, this is an open-ended target maturity date index fund which basically invests in the constituents of the CRISIL Gilt 2027 and the other fund invests in the CRISIL Gilt 2028 index. Mind you, this is not an equity index, it's an index which basically comprises of government securities. So what the fund is going to do is that it's going to invest in the same government bonds that are being held in this particular index. And of course, there's a maturity date. So the 2027 index matures on June 30th, 2027, and the 2028 index matures on April 5th, 2028. The fund believes that the 6-year space is a sweet spot because the yield curve is pretty high and the spread between government bonds and corporate bonds is at a low right now. So should you invest? If one were to consider for a period of 6 years, your options are other open-ended debt funds like short duration debt funds or dynamic bond funds. And as I have always said in the past that short-term debt funds provide better risk-adjusted returns because when we look at rolling returns on long-term periods also, what we see is that with gilt funds, essentially the volatility is extremely high as compared to short-term debt funds, and with high volatility, people tend to exit investments. I mean, even though there might be a target yield that has been specified and there is visibility of returns if you hold it for a 5-year period, but most people cannot stomach the volatility and they tend to exit the investment. What works clearly for the fund is that there is a specified yield that you're going to go with, and you're expecting to get that yield on a post-tax basis. In both the cases, it's expected to be somewhere between 5.9 to 6%. So certainly it's a good investment for those who are looking at it versus a fixed deposit, because a fixed deposit today will give you 6% taxable, whereas here you're getting about 5.9 to 6% post-tax. So those who want to look at a fixed return, yes, it's a good investment. But remember that we are in an increasing interest rate environment. And in an increasing interest rate environment, why would you want to lock in returns? Secondly, this fund only invests in government bonds. There are a whole lot of corporate bonds which give better returns. And certainly with the increasing interest rate environment, the corporate bond yields are going to be higher than what the gilt fund yields are. Of course, gilt fund provides you the best quality of credit because it's sovereign credit, which means that there's no risk of default. My take, I would say stay away. I would not like to lock in yields in a rising interest rate environment. Gilts are extremely volatile, and a fund like a short-term debt fund, which is a combination of corporate bonds and government securities, would do the job much better. Make sure you click on the bell icon to subscribe. We do look forward to your feedback. Till then, bye-bye.